Good morning and welcome to Charting the Markets on Monday, the 11th of December 2023. Asian markets started off the day on a positive footing as they continued the rallies seen last week in the US, despite solid unemployment data being seen in the United States. And earlier this morning, not much was really happening as investors are looking forward to a plethora, I should say, of central bank meetings, starting off on Wednesday by the Federal Open Market Committee in the US. And then on Wednesday, we've got the Bank of England, as well as the European Central Bank and the Swiss National Bank. Today's economic calendar is really empty, not much going on at all. So markets will probably trade in light volumes. And today, though, we do have, tomorrow, though, we will have UK unemployment, and then more importantly, the German ZEW economic sentiment indicator, as well as US CPI data releases. So let's begin by having a look at the FTSE 100. As we can see here, we did rally very briefly to levels last seen at the end of October on Friday of last week at 7,583. We made a little top here, and that was very markedly above the red line here, the 200-day simple moving average, which I had in view as an upside target for the last 3 weeks, as you may remember. And this has now today acted as resistance at 7,565. As you can see here, the candle that we're seeing on the FTSE 100 daily financial bet is becoming red as we are falling. And basically, this move is likely to happen on very little volatility. As I say, the economic data calendar is empty. There is, I think, just one earnings report out by Oracle later on today in the US, but that's about it. So not really much going on. And we've now slid through this potential support going back to previous resistance, the mid-November high and the late November highs between 7,035 and 43. We've slid through there, so they should now, going forward, act as a resistance. And we could actually, in this case, slide all the way down to the psychological 7,500 mark, below which we've got the orange line here, the 55-day simply moving average at 7,479. So the FTSE is slipping slightly. We also saw the FTSE slipping on mining stocks, basically weakening today, and they are a large component of the FTSE 100. In Germany, the story looks far more positive in that we managed to hit a new record all-time high earlier this morning on this daily financial bet at 16,818, before also then just slightly drifting lower on low volume in low volatility trading ahead of tomorrow's ZEW economic sentiment data and the US CPI data. So not much going on here. You can see we have a very strong uptrend in place. We're trading in all-time record highs, and basically that trend looks to continue. And short term, we are seeing some support here at Wednesday's high at 16,730, which we haven't even tested earlier this morning yet. We sort of held just slightly above there. And basically, as long as we stay above Friday's low at 16,630, the uptrend is very much intact. And let's have a look at the US markets, though, and especially at the S&P 500, because here the story is slightly different. We did on Friday on this daily financial bet rise above our July high at 4,607, ever so slightly, as you can see here, and are just treading water at the moment before the US session opens, because obviously you can see here on the IG bet you can trade in out of hours markets. And we have to see whether we can continue to rise, because if we can, the next upside target is 4,637. That is to say, the high going back to March of 2022. And around there, we may potentially cap, because after all, you can see here, we've had 7 consecutive weeks, or actually we have seen 6 consecutive weeks of gains for the S&P 500, and we actually also saw the same in Germany. But now we are noticing this, and that is called negative divergence on the relative strength index. You can see here the oscillator, the relative strength index, or the RSI, is making a lower high at Friday's high compared to the high it made at the beginning of the month on the 1st of December. But on the price chart, we made a higher high on Friday than we did on the 1st of December. And that's called negative divergence. And it does lead in most cases to at least a short-term retracement against the trend. So I wouldn't be surprised if over the next few days, perhaps around the data coming out of the US, perhaps inflation data out of the US tomorrow or on Wednesday with regards to the FOMC meeting, we could see a retracement take us through this uptrend line going back to the end of October and perhaps retest the 4,540 support area, which takes us all the way down to the late November low at 4,537. So that's really, really important support. If that were to give way, we could even slip to the mid-September high at 4,516. So right now, everything still looks bullish and will continue to do so as long as we stay above the last reaction low. That's to say Thursday's low at 4,544. And since that's very close to that 4,537 level I just mentioned, the late November low, I would use that as my line in the sand really for this bullish trend here. So basically, provided we stay above 4,537, further upside looks to be more likely than any downside reversal. But if we were to fall through that level, it could indicate a short-term top in the S&P 500. The US dollar regained some of its recent losses last week, and we can see the impact of that on the euro. If you look at the euro-dollar exchange rate, this fell to a level last seen about nearly a month ago at 107.24, also on the expectations that softer Eurozone inflation last week brought forward the European Central Bank's rate cut expectations. And we can see here very little volume taking place, low volatility trading, small candles, and now we are trading below this resistance area, which is basically made up of the 107.56 early November high, and then followed by last Thursday's high at 108.17 and the 200-day simply moving average here in red at 108.25. So between 108.17 and 25, we've got resistance and support. Below the 107.24 low from last week comes in around this orange line here, the 55-day simply moving average at 106.95, which incidentally is also the late October high, as you can see here. So not much going on there with regards to euro dollar. The breakout of these levels I've just mentioned may give you an indication of where the currency pair is going to head next. But until we break out, we're just trading in sideways trading range with little volatility and probably also little volume. Now, euro yen is kind of interesting because last week, on the back of the Bank of Japan Governor Kazuo Ueda hinting at a probable change next year in the Japanese central bank's monetary policy and the central bank starting to phase out its very strong stimulus, we had a very strong yen take us down in the dollar-yen exchange rate to 153 yen and 18 cents, a level last traded back in July of this year, before we then found support around the 200-day simple moving average and basically bounced off it. As you can see here today, we had a rally higher take us back up to the late October low at 157.70. So that is short-term resistance. And above that, we also have the November to December downtrend line at 158.90, which may cap the upside. Now, we are rising with regards to the dollar against the Japanese yen, despite the Japan Business Survey Index of larger manufacturing firms hitting a 2-year high earlier this morning. Right, we'll have to see whether we can actually continue this upward momentum that has been quite sharp so far, following last week's very sharp declines. If we were to manage to break through the downtrend and also the orange line here, the 55-day simply moving average, 159.55, we could then perhaps head back up again and resume our long-term uptrend in the currency pair, as you can see here. But as long as we stay below the 55-day simply moving average and also the high seen back in August at 159.76, we could actually stay in this downward trending phase, even if we have it interspersed by these bullish reversals. And the story is quite similar with regards to dollar yen. You can see here a very similar pattern, drop to the 200-day simply moving average here in red at 142 yen 34 cents. We actually went slightly lower to 141.63 on Thursday of last week. But then we formed this Harami pattern, of which we have broken out of to the upside today, taking us back to the late November, the 21st of November low at 147.15. So that should act as resistance together with the downtrend line here. If we were to also rise and close on a daily chart closing basis above Wednesday's high at 147.50, that's the last reaction high, a high which is higher than the one to its left and to its right on the candlestick chart, then we could actually have a reversal in place, take us back up to the 55-day simple moving average 149.18. So that only happens if we rise above 147.50. The Brent crude oil price is regaining some of its losses over the last week or so, which were on the back of OPEC Plus members not agreeing to output cuts. And you can see here that led to a very sharp sell-off in the oil price, taking us back to levels last traded in July of this year. But since then, we have regained, as I said, some of these losses and have bounced off last week's low here on this front-month futures contract at 74.16. So just around the $74 mark per barrel. And here the trend is still very much intact and it's pointing lower. I mean, if you see here, we this morning tried to retest Friday's high at $76.41, which was made very close to the mid-November low at $76.67, and that acted as resistance. So as long as that's the case, the downtrend remains in place, and we could actually fall through 74.16, in which case we could be heading all the way back down again towards the May lows and June lows between 71.85 and 71.40. So that is a distinct possibility. And it would only change if we were able to revert to the upside and actually rise above the late November high at $84.58, which is pretty unlikely. Moving on to the gold price, you can see here that spot gold, which only last week on Monday hit a new all-time record high, has come off that record high very swiftly as the US dollar regained lost ground and basically also on Friday slid through the October to December uptrend line, but also closed below it on a daily chart closing basis, as well as below the last reaction low here made on Tuesday, all of which is bearish for the gold price and leads me to believe that we are now heading back down again towards the high seen back in September of this year between $1,953 and $1,947 per troy ounce. Below there, we have really, really good support coming in between the red and the orange lines here, which are the 55 and 200-day simply moving average at $1,955 to $52 per troy ounce, and then also the November low at $1,932. But long story short, it looks as if we formed a top in the gold price and that into year end, we may actually slide lower. And the story is quite similar with regards to the silver price. As we can see here, very similar pattern. We had this huge bearish engulfing pattern after we hit this $25.77 per troy ounce high made on Monday of last week. That was a level last traded back in May of last year, but didn't take out the May high at $26.13. And instead, we very swiftly declined for 6 consecutive days so far. So well, we are on track for the first 6th consecutive day of falling prices with regards to the silver price. And you can see here that we are now in the process of approaching this October to December uptrend line, which comes in at $22.75, and failure there may actually take us back down again, not just to the $22.30 mid-September lows, but also towards the mid-November lows at $21.89. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.